Chapter 5 Legal Framework in this Capital Market Dealer module. It is one of the excellent chapter which gives us lot of inputs or guidelines about how to work in this particular capital market, how the registrations have to be done, how the process of transactions have to be carried out, what are the rules, regulations, responsibilities of all the participants in this particular capital market. From time to time, these procedures and regulations are being revised, established properly to ensure more smoother, more standardized form of regulations for operations of the capital markets. From time to time, these regulations are also revised and established to ensure international standards of systems and procedures to ensure the capital markets in India are well on par with international standards. There are so many regulatory authorities in India, especially in this particular capital markets, who govern the operations of the capital market segments. There are broadly 4 departments who are involved in this particular capital markets, who provide lot of rules, regulations, etc. We will try to get into all these details in this particular topic. Legal framework from the examination point of view has 9% marks. However, more than the percentage of weightage in the examination, it gives a clear guidelines to the participants in this particular capital markets to run their business in a more smoother and a neat manner regularly. Now, let us get into details about the various acts, the various authorities and rules, regulations for depositories, for SEBI Act, for insider trading rules, contracts, etc. The exigencies of the market and the flexibility of the regulators are maintained through the exercise of delegated legislation to the regulators. Under this, the regulators issue notifications, circulars and guidelines which are to be complied by the market participants in the capital market segments. The rules, regulations, guidelines provided by these authorities have to be adhered to regularly by all the market participants in capital markets, and this is a must. Various activities in the securities market in India are regulated in a more coordinated manner by 4 regulators, namely Department of Economic Affairs of Ministry of Finance, Ministry of Company Affairs, this is a second regulator, third Securities Exchange Board of India, and fourth Reserve Bank of India. So, these 4 people are the main regulators for the capital market segment. The regulatory and supervisory framework of the securities market in India has been progressively strengthened through various legislative, administrative measures and is consistent with the best international benchmarks such as the standards prescribed by International Organization of Securities Commission. So, all the regulations are on par with this particular IOSCO, International Organization of Securities Commissions. Now, let us try to get into some more rules and regulations as per the acts provided. The government has framed rules under Security Contracts Regulation Act, then SEBI Act and Depositories Act. SEBI has framed regulations under SEBI Act and also the Depositories Act for registration and regulation of all the market intermediaries for prevention of unfair trade practices, insider trading, etc. So, the rules of SEBI Act, the rules of Depositories Act, the rules of Security Contract Regulation Acts helps to transact or helps the market to have a fair activity during the course of the business. Government and SEBI issue notifications, they issue guidelines and circulars which need to be complied by all the market participants. The self-regulatory organizations, popularly known as SRO, like the stock exchanges, like NSE, have also laid down their own rules and regulations for the market participants also. Now, coming to the regulators ensure that the market participants behave in a desired manner so that security market continues to be a major source of finance for corporate, for government, and for the interest of the investors are also properly protected. Because the main aspect or objective of the regulators are three. One is to regulate the market, two, to develop the market, three, protect the investors' interest. Based on these three parameters, all the acts, rules, regulations, guidelines are developed to have a smooth activity and a fair activities in the stock market. As noted, the responsibility for regulating the securities market is shared by Department of Economic Affairs, Ministry of Company Affairs, SEBI and RBI. Now, let us try to get into various acts. The first one being SEBI Intermediaries Regulations Act. As the name of regulations indicate, these are the regulations which are giving guidelines or governing the activity, the registrations, the regulations with regard to the intermediaries. Intermediaries are all the people who are providing the services in the capital market segment. Now, what are these SEBI Intermediate Regulations 2008? One of the main functions of SEBI is to register and regulate the functioning of various types of intermediaries and persons associated with the securities market in a manner to ensure smooth functioning of the markets and protection of interests of the investors. These intermediaries, as detailed in the SEBI Act, are stockbroker, sub-broker, share transfer agents, bankers to an issue, trustees of the trust deed, registrars to an issue, merchant bankers, underwriters, portfolio managers, investment advisors, depositories, participants, custodians of securities, foreign institutional investors, credit rating agencies like CRISIL and CARE, asset management companies and clearing members of a clearing corporation like NSCCL, trading members of a derivative segment of the stock exchanges like all the brokerages, the collective investment schemes, venture capital funds, mutual funds and any other intermediary associated with the securities market. These form a complete gamut of the market participants in capital market. So, all these people have to be properly registered under SEBI. SEBI had issued regulations governing the registration and regulatory framework for each of these intermediaries. So, they have given proper guidelines for each and every participant how they have to register and how they carry out the business in the capital market. However, given the fact many requirements and obligations of most of these intermediaries are common, SEBI has recently consolidated all these requirements and issued SEBI Intermediaries Regulations 2008. These regulations are notified on 26th May 2009. These regulations apply to all the intermediaries we have mentioned. except foreign institutional investors, foreign venture capital investors, mutual funds, collective investment schemes, and venture capital funds for whom there are slightly different type of rules, regulations. What are the salient features of these regulations? Let us try to see one by one. Let us take the first one. The SEBI regulations put in place a comprehensive regulation which is applicable to all the intermediaries. The common requirements such as grant of registrations, general obligations, the common code of conduct, the common procedure for action in case of default, and miscellaneous provisions are applicable for all these intermediaries. Second point, the fit and proper criteria have been modified to make it principle based. The common code of conduct has been specified at one place only. The registration granted to these intermediaries has been made permanent unless surrendered by the intermediary or suspended or cancelled in accordance with these regulations. That means, once these intermediaries get registered, that registration will stand permanent forever, unless and until they are suspended, they are cancelled, or they themselves go for surrender of the registration. That registration which has been given by SEBI initially will stay always till the end. Procedure for action in case of default and manner of suspension or cancellation of certificate has been simplified to shorten the time usually faced by the parties without compromising with the right of reasonable opportunity to be heard. Surrender of certificate has been enabled without going through lengthy procedures. So, once these registrations are there, those registrations will stay permanent, and those registrations will not be just cancelled or surrendered or suspended just like that. All the procedures are clearly given in what cases all this cancellation, surrender, suspension will take place, and all this effect of such suspensions, surrendering, or even cancellations will be done in a proper manner, in a simpler manner, and in a decent manner to be giving a fair justice to everyone participating in this particular process. Now, SEBI Prohibition of Insider Trading Regulations 1992. Insider trading is one of the important aspects in the stock market which can destabilize the activity of certain securities, or even it can distract the equilibrium of the market. To ensure a fair activity in each and every security and all the securities in the capital market, proper, strict, and very tough, rigorous rules are established with respect to insider trading. This ensures everyone, all the investors are given the fair chance to invest properly with proper information, and no insider is able to take undue advantage of the sensitive information these people are holding. Generally, the insiders are people related with the company's promoters relations, directors, directly, indirectly related people with this company are definitely in possession of lot of sensitive information which can affect the values or the prices of those securities in the market. So, to ensure such misuse of sensitive information by few selected people, especially the insiders, are not misguiding or misleading or taking advantage of that particular situation, the investor is given justice, a due proportion of strength to ensure the activity of the share price in the market are run properly and no one is taking advantage, especially those insiders who are related with this particular company. So, let us try to see what are the rules and regulations which are properly designed to ensure smooth activity of that particular stock. The malpractice of insider trading affects innocent investors. In simple terms, insider trading means selling or buying in securities on the basis of price sensitive unpublished information of a listed corporate, which if published could lead to a fall or rise in the prices of the shares of that particular corporate. To tackle the problem of insider trading, SEBI issued SEBI Insider Trading Regulations 1992. These regulations were made stringent through amendments in February 2002, and they were notified as SEBI Insider Trading Amendment Regulations 2002. Now, in this particular insider trading, we will try to see what are the important definitions used in the regulations. First, dealing in securities. As per this particular regulations rules, what is dealing in securities? It means an act of subscribing, buying, selling or agreeing to subscribe, buy, sell or deal in any securities by any person either as principal or agent. 2. Insider means any person who is or was connected with the company or is deemed to have been connected with the company and who is reasonably expected to have access to unpublished price sensitive information in respect of these securities of a company, or who has received or has had access to such unpublished price sensitive information. So, these people who are having such relation are called insiders. Third, a connected person. Who is a connected person? A connected person means any person who is a director as defined in clause 13 of section 2 of Companies Act 1956 of a company, or is deemed to be a director of that company by virtue of subclause 10 of section 307 of that particular act, or a connected person also can be he who occupies the position as an officer or as an employee of the company, or holds a position involving a professional or business relationship between himself and the company, whether temporary or permanent, and who may reasonably be expected to have an access to unpublished price information in relation to that particular company. Finally, price sensitive information. So, what is price sensitive information? It means any information which is related directly or indirectly to a company and which, if published, is likely to materially affect the price of securities of a company. It includes any such information which, if published, is likely to materially affect the price of securities of that particular company. The following are deemed to be price sensitive informations. 1. Periodical financial results of the company. 2. Intended declaration of dividends, both interim dividend and final dividend. Issue of securities or buyback of securities. Any major expansion plans or execution of new projects. Amalgamation, mergers or takeovers information. Disposal of the whole or substantial part of the undertaking. Significant changes in policies, plans or operations of that particular company. So, these are the 7 categories of information which are categorized under price sensitive information. Finally, unpublished information. What is unpublished information? It means information which is not published by the company or its agent and is not specific in nature. However, speculative reports in print or electronic media are not considered as published information. So, these are the main 5 important definitions under the insider trading regulations definitions. We will now try to get into disclosures and internal procedure for prevention of insider trading as per chapter 4. Now, from time to time lot of insiders activity keeps taking place, but to certain extent that is also acceptable with respect to buying and selling of securities, provided that transactions are properly intimated within the specified time, then they are acceptable. Now, we will try to see what are these provisions for insider trading. All listed companies and organizations associated with security markets such as intermediaries, asset management companies, trustees of mutual funds, self-regulatory organizations recognized by SEBI, the recognized stock exchanges, clearing houses or corporations, public financial institutions and professional firms such as auditors, accountancy firm, law firms, analysts, consultants, etc., assisting or advising these listed companies are required to frame a code of internal procedure and conduct as per the prescribed format provided in SEBI Prohibition of Insider Trading Regulations Act, without diluting it any manner and ensure compliance of that particular rules. That means all the people who are having some sort of a facility or access to certain information, if they are trying to transact or do any sort of buying and selling, they are supposed to follow certain guidelines provided under SEBI Prohibition of Insider Trading Regulations. The regulations require certain disclosures to be made by directors, officers and substantial shareholders in listed companies. These are, first we will try to discuss under initial disclosure clause and continual disclosure clause, and third one, disclosure by company to stock exchanges. Now, first we will get into initial disclosure rules. First, under initial disclosures there are 2 important points. The first point is, any person who holds more than 5% shares or voting rights in any listed company should disclose to that particular company in a prescribed form the number of shares or voting rights held by such person on becoming such holder within 2 working days of the receipt of intimation of allotment of shares to them, or the acquisition of shares or voting rights as the case may be. The second point under initial disclosure, any person who is a director or officer of a listed company should disclose to the company in the prescribed form number of shares or voting rights held by such person within 2 working days of becoming a director or officer of that particular company. These are initial disclosures which people have to make. One is persons who are having a claim or having a holding of 5%, another ones people who are directors or officers of this particular listed companies. What are the rules we have just discussed in the initial disclosure clause. Now, continual disclosure, second category. In this also we have 2 points which we have to remember about the rules pertaining the continual disclosure clause of SEBI regulations. Any person who holds more than 5% shares or voting rights in any listed company should disclose to the company in the prescribed form the number of shares or voting rights held and the change in the shareholding or change in the voting rights, even if such change results in shareholding falling below 5%. If there has been change in such holdings from the last disclosure and such change exceeds 2% of total shareholding or voting rights in that particular company. That means, if he is already a shareholder having more than 5% holding, and if any holding levels or voting right issues have changed, in such cases they have to intimate in the proper format to the company. The second category of people who has to follow this continual disclosure procedure are persons who is a director or officer of a listed company should disclose to the company in the prescribed form the total number of shares or voting rights held by them and the change in that shareholding or voting rights if there has been a change in such holding from the last disclosure made by these people, and this change if it exceeds 5 lakhs or 25,000 shares or 1% of the total shareholding or voting rights, whichever is lower. The disclosure mentioned about should be made within 2 working days to the company after receipt of intimation of such allotment of shares or acquisition or sale of shares or voting rights as the case may be. So, if there is any sort of a change in the shareholding as per the 3 norms provided, they are supposed to intimate within 2 working days as per the change that has been effected in their shareholding pattern. The third clause is the disclosure by this company to the stock exchanges. Till now we have seen the important disclosures. The people who are having good holding or directors or officers of the company whose shareholding patterns are changing have to inform to the company within 2 working days. In this we have seen initial disclosures of these directors or people who are holding more than 5%, or even the continual disclosures procedures required for this 5% holding people in the company or directors or any other officer of that particular company. So, after this initial disclosure clause and after continual disclosure clause, we are trying to find out the third point, the disclosure by company to the stock exchanges. Every listed company within 2 days of receipt of such information from the directors, officers or people who are holding more than 5% shareholding should disclose all such informations to stock exchanges on which the company is listed. The information related to the continual and initial disclosure given above. The disclosures required under this regulation may also be made through electronic filing in accordance with the system devised by the stock exchanges. Further, the SEBI Act, which inter alia prescribes penalty of insider trading under section 15G amended in 2002 to increase penalty for insider trading to the extent of 25 crores or 3 times the amount of profits made out of insider trading, whichever is higher. So, there will be penalties in case insider trading has been vigorously done without any proper rules and regulations, then there can be huge penalties to the extent of 25 crores or 3 times the amount of profits they would have made. Now, these are insider trading rules, regulations, procedures.